Victor's only co-host, so you're obviously more important today.
We have one more tier also. No, Megan is always important for us.
All right, your live stream, so I'll give you back host, and then you are.
Okay. Does that live stream go on right when you do it, or does it also come on when the participants come on? Do you know?
Yep, we are on live right now.
Okay.
Yeah.
Thanks for that.
We have 2 minutes.
Okay, Victor, this is a test for you. I am right now putting my light on. No, it's not working. Uh-oh. Oh, it's the wrong one. Okay. So you see if you see a difference or not. Actually, I should put my overhead light on too. You notice a difference?
No,
Yes, I guess that's a no.
It looks the same.
You look a little brighter.
Okay.
Yes,
That means smarter or no, he's kidding.
So is it a ring light you got for your
Yes.
computer?
Yeah.
Nice.
Okay.
And then I'm going to stay for a bit for a check-in too. So I'll
Okay.
put the email in the chat.
All right. Sounds good. Hi, Carol Sue. Hi, Mary. How are you today? How's everyone doing?
I'm fine, thank you.
Good. I recognize
I'm fine,
that.
thank
face.
you.
Hey, Cheryl.
So yeah, Philip, I'll be in the background. Okay. All right. So I'll just putting my camera off.
Okay.
Right. Okay. Cool.
All right. Hi, Barbara. Hi, Joanne. So everybody, people are popping in. So just trying to keep track of everybody. If I miss your name,
Hello, how are you?
wonderful. Thanks. So,
Good to hear you.
all right. So as you signed in, if you're getting signed in, Megan's here. When you get
It's as
set
loud
up.
as it goes.
Any technical difficulties, just text with or chat with Megan and she'll help you out if you're having some audio or video troubles, and we'll get started here as everybody loads in. And then there's, to make it a little more confusing for everyone, there's a Philip, which is me, and there's a Phil here. So Phil is going to be monitoring working the class with me and Victor behind the scenes. They'll be helping me with any chat questions we may have. So we'll all work together in regards to that. So let's go ahead and get started. We may have a few more people joining us, but this is a session on understanding money and investing options. So making your money work for you. So a little bit about me. Again, my name is Philip. I live in Chicago. I did spend 40 years in the corporate world. I was not in finance or investing. I just have enjoyed reading about investing and finance during my life. And I also do some architecture and do some architectural classes here. So I'm not a registered agent or anything like that. We're not going to give specific investment advice during this class. We'll have a little disclaimer in a second, but we're going to talk about the characteristics of investing and what we need to be looking out for, so to speak. So as most of you know, you've been with other Get Set Up classes. Ideally, we learn from talking with each other and interacting. And if you have the ability to have your camera on, that will just make it a little bit easier for all of us. But I totally understand if you can't today. This class is being recorded, mostly for training purposes for me. But attending the class, you can also get a copy of the recording. You would ask through it or ask for it through help@getsetup.io, the address I'm circling with my cursor right now. And we are on Facebook live streaming also. So those of you that join us on the live stream, thanks so much for joining us. And if in the future you want to be able to participate and ask questions directly, you can sign up directly with Get Set Up. And we probably won't talk about any products today unless somebody has a question about something, but just in case we do, just want to confirm that Get Set Up does not pay or get paid to promote any specific products that we may have. So I just want to set up the class a little bit and do some objectives, then I'll turn it over to all of you and anybody that wants to say a few words about themselves, maybe where they're from and what they want to get out of this class, that would be great. So let's just talk about the objectives first. So there's different money buckets, and we'll talk more about that in a minute, but how they relate to investing. Then we're going to talk about some basic investment strategies and their levels of risk. And we'll close out with some basic investing thoughts. So as we see on the bottom of the screen, this is not an advisory course, nor do we give advice on investments. It's informational class only. And as I said before, I am not an investment advisor. So with that, if anybody wants to say a few words about themselves and what they hope to get out of this class, I will turn it over to all of you. All right, the first one's always the hardest. Anybody want to bat first?
I'll go. I know nothing about investing, and I just hear lots of stuff on the TV and stuff like that. So I'm here out of curiosity, and I'm open-minded and want to take and learn, taking more. And that's about taking it.
All right, Carol Sue, thanks so much. All right, if nobody else wants to go, we'll just go ahead and get right into the class. So please, let's make the class interactive. There will be a lot of material here. Please feel free to ask questions as we go. You can use the chat, of course, but you can also just unmute yourself and ask the question directly. I like having questions, make sure we're all understanding the topics, and it really helps to have some interaction as we go, so we all can make sure we're all on the same page. And a couple of you also putting through the chat where you're from, and I appreciate it, and enjoy the class. Also, so let's just talk about some money buckets, different groups of money. So generally what you'll hear investment experts and advisors talk about short-term money, and then sort of middle-term money and long-term money. So what's this all about? So most experts will say short-term money is 2, some will say 3 years. And basically what is being talked about here is that the short-term money is something you do not want to have a lot of investment risk in, which basically means having that money in stocks. So when we say money up to 2 years, that is money, this is especially if you're in retirement already, money that you're going to be pulling out of your investment account over the next 2 years, because we don't know what's going to happen with the stock market. It could drastically go up or drastically go down. And in particular, if the market is going down heavily, you don't want to have to sell stocks. And even some bonds could have some risk to it. So most people are going to talk about having your short-term money you're going to be pulling out of your investments basically in cash. And by cash, it can literally be a money market account or a CD, a certificate of deposit, are the two most common places where people would store that short-term money. So basically the way you determine your short-term needs is how much money you are going to be pulling out of your investments over the next couple of years. And then as you pull some money out at the right time in the market, you can shift some of your middle money into the short-term money. So the middle term is generally from 2 to 3 years, depending on the investment expert, and generally goes to about 7 or 8 years. So this is money you don't need right away.
Turn it.
absorb a little more risk. And so you might put this in some stocks, some conservative stocks. We'll talk more about this in a couple of minutes. And then your long-term money is money that you will not need for at least 7 to 10 years. And that money you can invest, so to speak, in the stock market at a riskier level of investment for most people. And again, we're going to talk in a few minutes about what this risk means and how the risk relates to what we want to invest in. So this is just if your investment advisor is talking about short-term money, that's what they're talking about money that you're going to be pulling out of your investments over the next couple of years to live on. So questions, comments about the short and long-term money?
Yes, do each they can have like each can have a high risk, correct?
Well, the whole idea, Carol Sue, is to have that short-term money not have very much risk.
Okay.
So if you do have it in a money market or a certificate of deposit, it's not going to make much money, but it is
Right.
not going to lose any money. So that is really not a relatively risky investment because you're not going to have it for very long.
Okay.
The risk is you don't want to leave all your money like that because then you're not going to be able to keep up with inflation. So that's why we need some riskier money in some of the things that we might have later.
Okay.
And when we talk about these 3 buckets, we don't mean they need to be in 3 different investment accounts. They just need to be, they can all be within the same investment account, just invested in different types of investment. So we're not talking about having 3 different accounts. We're talking about having within your one investment account, having 3 types of, or 3 buckets of money, so to speak. Okay. Generally, I have some little fun with some questions, but we have a lot of people here today, and so I think we'll just get some regular questions as we go. So I'm gonna skip some of the little pop cash questions I sometimes ask. So let's talk about stocks and bonds. That's what most people think about or should think about when we're talking about investments. So bonds is either a government or a company that borrows money from you with the agreement to pay you a set rate of interest. And then generally you're going to do that investment for a certain period of time. It may be 2 years, and maybe 5 years, and maybe 10 years, and maybe 20 years. At the end of the term of that loan, you generally get your initial investment back. And then throughout the time that you've held it, you get some interest. So big difference between government. Sorry, thought I had my phone on mute. Big difference between government and company. So governments are considered, most governments are considered more stable than companies, especially the US government. So the less risk there is in a bond, the less interest you have to pay. So US government bonds are considered the safest investment in the world by almost all experts. So the US government can get away with giving you a little less interest than other entities, either governments or companies. You have some other governments that are relatively stable, and their interest rates are probably a little bit higher in the United States. And then you can have some governments that are relatively risky. Some right now, some of the South American governments have some challenges, and a couple in the eastern part of Europe where their investments are considered pretty risky. So they have to give you more interest for you to consider lending them their money. The same characteristic goes for companies. So a company like Google, who is in very good financial status right now, would not have to pay as much in interest to you as, say, somebody like General Electric right now, who is considered to be a little bit more unstable. So General Electric would have to pay you higher interest to get your money, to get you to invest and lend them money. Does that make sense? Questions? So I say here, generally you get your initial investment back when you hold the bond to maturity. Till maturity means when the loan is up. I say generally because if in the meantime, if the company goes bankrupt or the government goes bankrupt, you will not get your money back. So that's why you have to balance how much risk you want to take even with bonds. Bonds are considered generally a lot less risky than stock, but there is still some risks in them. So stocks basically are ownership of a company. So if you buy stock in Google, you are part owner of that company. So some stocks do pay dividends, which is a regular amount of money that they would pay usually in 3-month increments, but a stock or a company does not have to give any dividends. And even if they pay dividends today, they don't have to pay dividends in the future. So when you're buying a stock, you are investing in believing that the company will continue to grow and will gain in value. And then when you sell the stock, if you are successful with that ownership of it, you will sell it for more than you bought it for. And that's where your gain or your profit comes in. So let's talk about the risk of both of these. The big thing about investing is your risk factor. So as we talked about, stocks offer no return, no guarantee of a return. Again, they don't have to offer dividends. They don't have to keep paying dividends, while bonds do give you a flow of money by their interest payments. So because of that, bonds are usually considered less risky than stocks. So now, having said all that, probably most of us that are here today probably should not invest directly in either stocks or bonds. We should probably buy mutual funds or electronically traded funds, and we'll spend some time talking about those in a few more minutes towards the end of the session today. So there are other kinds of investments. There's real estate. There's what are called commodities, which are things like oil or grains or gold. But we're going to stick with the two basic ones, and we're going to compare on the next, as we go to the next page, we're going to compare the risk factors. So this is really the most important thing we want to talk about today, is comparing the risk considerations. So before we tackle this page here, what questions do we have? I see Linda talks about how do ETFs differ from mutual funds. Linda, I will spend, if you don't mind, let's talk about the risks first, and I'll spend about 5 or 10 minutes talking about the differences between those two after we go through this slide, if you don't mind. So first off, this information is from Vanguard. Vanguard's a big investment company. I just chose them because they have the easy, they had an easy way to get this. So this is the historical return. So this is almost 100 years of history. This is from 1926 to 2019. So 94 years of history in regards to stocks and bonds. So what we talked about earlier was that stocks are riskier than bonds. So when you talk about riskier, that means you have a higher chance to make more money, but you also have a higher chance to lose more money. So this is what we're going to talk about now. So what we're going to do is compare 3 combinations of stocks and bonds. So this first column here has 30% in stock, 70% in bonds. So bonds being less risky, this is considered a very relatively conservative type of investment combination between stocks and bonds. The next category is going to be 50% in stock, 50% in bonds. So it's generally considered relatively moderate or a medium type of investment from a risk standpoint. The third category I'm going to look at is 70% bond. I'm sorry, 70% stock and 30% bond. So it's clearly riskier. Remember, the more stocks you have, the riskier it is. So this is the riskiest of the three different buckets or categories we're going to look at. So again, you can have actually any combination between the two in your investments. These are just some typical conservative, medium, and aggressive forms. So now what we want to do is see how these have performed over the last 94 years. So the average annual return, so that means how much on average over those 94 years, this combination of 30% stock, 70% in bonds, it has made 7.2% on average per year. So that means your investments went up 7.2% on average per year. If we look at the 50-50 category, we can see that this number is 8.3%. So this is a riskier portfolio, more stocks than this. So it makes sense that this makes more money. As we said, stocks generally go up and down more than bonds do. And then the riskier of these three portfolios was 70% in stock. As you can see, on average over the last 94 years or through 2019, this package of stocks and bonds averaged 9.2% increase per year. So right now it makes a lot of sense. We just look at this line. Obviously, we want to be in the riskier category because we're making more money on average over all these years. Over these 94 years, we're making more money here. So it makes sense. If we look at the next line, what was the one best year of these 94? Again, the most conservative investment was up over 28%. That medium investment was up 36%, just over 36% for the best year. And then the riskiest of our three investment buckets that we have was up 44.4% in the best year. So again, it seems to make sense to go with the riskier investments. We're making more money on average, and we made the best year, we made more money. So now comes the challenge, the opposite. So the worst year in this one with 30% in stock, the most conservative investment, the worst year, in 1 year, it lost 15%. So that means if you were in the stock market in that worst year, if you started the year with $1 million, you end up with just under $850,000. So you lost 15% of your investment. That middle investment, the worst year, it went down 23.5%. And then the riskier investment, which seemed to be good so far, you can see its worst year was down over 31%, over 31.5%, 31.6%. So that means if you had $100,000 in the market at the start of this worst year, you ended the year with less than $690,000. You lost over $31,000 of your $100,000. So this is where the combination of the risk versus reward happens. When things are going good, the riskier your portfolio, the better. But when things are going bad, they drop. As you can see, this worst year was 15%. The worst year is 31%. Big difference in how much they drop. And then the other thing to look at is, of those 94 years, how many of those 94 years had a loss in them? For the most conservative of our three types of investments, 15 years out of 94 had a loss, 18 years out of 94 for our middle one, and 23 years out of 94 for our most aggressive portfolio or bucket actually had a loss. So the goal of this is to help us better understand the risk involved. So the big question is if your portfolio is really going down heavily on a bad year, can you sleep at night? Can you not panic? Can you not sell some of your stocks? That's what your investment advisor is going to ask you. So when you first start working with your investment advisor, and then every couple of years, they should also check, they're going to ask you some questions, which basically is trying to establish what your risk tolerance is. How much risk can you take? So they're going to ask you a series of questions, giving you some ABC type examples in which to answer as to how much. And then by answering all those questions, they determine sort of which of these general buckets you should go in: conservative, medium, or aggressive. The other general rule of thumb for investing is, as we age, we should probably shift a little bit more conservatively than when we're younger. And most experts say around the time you get to be 50 or 55, you should start moving a little bit more conservative than where you were before. But that, again, is a rule of thumb, and everybody has to have their own risk tolerance. So there's a lot here. I think this is the crux to what we really want to cover. So I'm going to open it up to questions, please.
Yeah, Phil, if you have questions in the Zoom chat, actually.
Yep. How does age impact your risk consideration? So I think you had that in there before I talked about it. But generally, as we age, we should go a little bit less risky. I'm not saying you drop from one to the other, because you may have been here when you were younger. You may have been fairly conservative anyway, and then you want to shift a little bit this way. When you're 45, if you were more aggressive, you might have been here, and you're going to shift a little bit more this way. So there's no one answer where you end up, but you usually end up with more bonds and less stocks as you get a little bit older. How do the political changes impact the market? That's a very good question. You know, generally, Republican administrations are considered to be more business friendly, which would help the stock market. But surprisingly, the actual analysis doesn't always back that up. It just really is probably not as big of an influence as some of us consider it to be, because some Republican administrations have had some pretty bad market times, and some Democratic ones have had some good ones. So there isn't really a good barometer just because a Republican or a Democrat is in the White House to say that the stock market is going to go more likely to go up or down. There is a lot of research on that, and you can look at some of that. So, and then Linda talks about up here, doesn't it depend on how close you are to retirement? That's absolutely right. As we say, as you move closer to retirement, we want to push back a little bit to the right. Are bonds still being sold in today's market? Yes. So bonds are, again, we're going to talk about mutual funds in a few minutes and how we should probably invest, but bonds are constantly being sold. You can buy existing bonds or you can buy new bonds. So a new bond is literally one that is new to the market, and it will have a period of, like we said earlier, it could be 2 years, 5 years, 10 years. And then existing bonds are ones that have already been originally sold earlier, and the person that had them wants to get out of those bonds, and then you can buy them middle of the term also. But yes, bonds are still being sold today, both new ones and existing ones. So a question about, oh, go ahead. Who is?
This is Renee. I thought I came to class early, but it looks like you're well into the class. So did I got the wrong class? This is what I want to know about. This is the class I thought I took.
Okay, I don't know whether
When did you start?
Renee froze or I froze.
When did you start?
Renee, I'm sorry. You froze on me. It might be from my end, but I couldn't hear you.
Okay. When did you start the class?
When did I start the class? On the half hour. So
Oh,
we're about halfway through it right now.
I'm sorry.
Okay.
I still want to listen. Sorry.
Okay. That's fine. You can always take the class another time. You can continue with it now also and still take it again if you want.
Okay, thank you.
Sure. So somebody has a question, should we be more focused on dividends as we age? That's a very good question to consider. So some people try just to live off of their dividends, and other people will want to live off their dividends plus selling some of their stocks and or bonds. So generally we probably want to, let's start. Typically, stocks that pay more in dividends are considered more conservative than stocks that pay little or no dividends. So that's the first perspective. So with that as your basis, then generally more conservative stocks are more likely to pay some dividends. So that sort of matches with the age factor. Plus, a good way to get some money out to use to fund your lifestyle, to take money out of your investments, is from dividends. That's what a lot of people do is they do not what's called reinvest their dividends. Instead of buying more stock when a company gives out dividends, they end up just taking it out as cash upon which to live in. So, really the goal of this class is for you to help you make sure we all understand what's going on. As far as what you specifically do, we're here to give you the information so you can make the decisions that are correct for you. So a question like that is, I want you to understand about generally how dividends work, but the actual decision is one that you would end up making as far as you want to look more for dividends. So Linda asked a tax question, and I'm also not a tax accountant, but it says, are dividends considered regular income or long-term capital gain? So it depends how long you've owned the stock. So I'm not trying to duck the question, but it depends on how long you've owned the stock. Basically, again, I'm not a tax person, but typically, if you've owned the stock for over a year, they're considered long-term gains. And it's less than a year, they're short-term gains, and those are taxed differently. So lots of good questions here. So, all right, let's talk about some investment considerations. So the first one is age, and you guys have done a nice job of already asking me about age. So we've talked about that as a general consideration. And then the next big one is asset allocation. And really, this is asset allocation. Asset allocation is what percent you have in stock and what percent you have in bonds. So asset allocation is considered by most experts to be really one of the most important things. It's more important what percentage you have in stocks and bonds than which particular stocks or bonds you buy, according to most experts and according to most research that has been done. So these are really two heavy considerations for us all to think about as we invest. As you can see, I actually have a little space between them because I really consider these the top two to be considering. How long until you need your money? That was one of the very first screen we talked about. If you need money in the next couple of years, you want to invest that really in cash. You really don't want to even have it in stocks or bonds. The longer it is until you need your money, the riskier you can probably invest. And that makes sense. That's why a 30-year-old or a 35-year-old can have a riskier portfolio, because they're not going to need their money for a longer period of time, assuming that money is for investments. Now, if that 35-year-old intends to buy a house in 2 years with that money, typical investment advice is they should not be risky with that money because they are going to pull it out in a couple of years, which is very similar to what we talked about when we get older and we're trying to take money out for a living. So the age itself isn't the key. It's how long you're going to be able to invest that money before you need to take it out. There are different fees for different type of investments. We'll talk a little bit more about that when we compare mutual funds and electronically traded funds. And that's what we're going to talk about next. And then the other big consideration is your money in a tax deferred account or not. So a tax deferred account is something like an IRA or a 401k, where there are exceptions, but generally you have not taken out taxes yet. And you will take out taxes when you start withdrawing that money as you age. There are some exceptions. There are some Roth tax accounts, and those are the opposite. You actually pay the taxes early and you don't pay taxes when you take it out. So again, these are all things to discuss with your investment advisor, but just want to understand that the money you have in an IRA has different implications than the money you have in your regular investing account, which has not had any tax influences on it, any tax deferment. So, and then the final point on here is make sure you understand your investment advisor's philosophy and how he or she gets paid. That's the big thing, is understanding, and they really should be understanding your philosophy by asking you a lot of questions. Especially when you first meet with an investment advisor, if they're doing a lot of the talking and you're doing a lot of the listening, that's generally considered a bad thing. They should be asking you a lot of questions, finding out about you, finding out about what you want to do in the future, finding out about how many kids you have, what you want to do with your money. Do you want to spend it all down as you're living? Do you want to try to save some money for inheritance? All kinds of things they should be asking you. So you should be doing most of the talking in regards to answering their questions when you're looking for an investment advisor if you don't already have one. But once you figure out that they're good at explaining things to you and you feel comfortable with them, you want to also find out how they charge fees. Okay, what about required minimum distributions at 70? How are those typically handled? So this is for a tax deferred account for an IRA would be a typical thing. So again, I'm not a tax accountant, but and I'm sorry, I don't, the first name looks like you have an initial there. In the tax law change that happened last year, based on the coronavirus, the minimum required distribution age has been increased to 72 if you weren't already 70, from my understanding. Again, this is a tax question from my understanding. So now going forward, if you weren't 70 years old last year, if you're younger than 70 last year, you don't have to take out money till 72 versus 70 per the new tax law. So basically, to answer the question, we talked about the tax deferred account. So the money that you put into an IRA or a 401k is generally not taxed when you put it in. So the government has not collected any taxes. The government wants to collect taxes. So the way they make sure that they're going to collect some taxes is when you get to be age 70 or 72, you are required to take out some of your investment money, whether you need it or not. And that's the required minimum distribution that this question is asking. So once you become that age of 72, there is basically a formula that your investment advisor will calculate for you. And you have to take out a certain amount of money and you have to pay taxes on that money. So that's where the government gets the taxes. They did not get taxes coming in, but they're going to get taxes taken out. And to make sure that you do it, they force you to start taking money out, whether you need it or not, and it's taxed, like I said a second ago. So that's what a requirement minimum distribution is. So that's something else to consider, is you don't want to get caught with forcing to sell some stock because the government wants you to take out a certain amount of money if the stock market is going down heavily. So that's another interesting consideration you have to take. That's getting pretty technical. But if you are age 72 or above, you have to make sure you understand those concepts, because you get a big penalty if you don't take out the money you need to. So other questions? Like I said, please feel free to unmute yourself if you want. All right, let's then talk about mutual funds versus ETFs. So mutual funds are the guys that have been around, the gals, whatever you want to call them, have been around for a long time. Mutual funds have been around for close to 100 years. So mutual funds are basically an investment advisor, a pro, buys a group of stocks and or bonds, or stocks and bonds together to help you have less risk. Because if you buy just one stock, it's very risky because your whole portfolio is based on that one stock. So generally it's considered you should have multiple stocks. So a mutual fund basically does the investing for you, and they buy stocks and or bonds, and they can have anywhere from 20 or 30 of them to hundreds of them in their portfolio. So you're buying, if you buy a mutual fund and you buy $10,000 of a mutual fund, you've bought $10,000 of that entire portfolio they have. So again, mutual funds are very common. Most of your investments in your 401ks and most of the investments that I would anticipate most of your investment advisors would talk to you about are mutual funds, or have been mutual funds in the past. Over the past 20 or 25 years, there's been a relatively new investment called electronically traded funds. So they're sort of like the stepchild. They have a lot of similarities to mutual funds, but a couple of differences. So we're going to talk about those contrasts, but just like mutual funds, they buy a bucket, they buy a group of stocks and or bonds. So how they invest or what they invest in are very similar. So three specific things to think about, I think, are the big differences between the two. One are costs. So you have an investment advisor who's doing all your investing. They want to get paid some money, which they should. So that's called their operating expense. So typically, electronically traded funds have a lower operating expense than a mutual fund does. Now, the mutual funds, like I said, this is a new younger cousin coming into the field of the EFT. So mutual funds are now having, a lot of them are reducing their operating expenses to try to stay in tune with the EFTs and not lose business to the electronically traded funds. So operating costs are going down overall, but typically the electronically traded funds have lower operating costs. So the less their cost, the more money you make, right, in your investment. So this, we talked about earlier about watching your fees. These are one of the fees we're talking about. Typically, as most of us as investors would have two types of fees to worry about. One is within the mutual fund or EFT, and then the second one is what our what our advisor is charging for their expertise. So that's very important. The next one, how you buy them, is not quite as important in my mind, but there is some differences. So if you buy an electronically traded fund, it's just like buying a stock. You can buy it anytime that the stock market's open, which is, it starts trading at 9:30 in the morning New York time and trades till 4 o'clock New York time. So you can buy a specific price, a specific dollar amount, specific price, and it's varying at all times, minute by minute. The value of a mutual fund is going up or down. I'm sorry, the value of an electronically traded fund, my bad, is going up or down. A mutual fund is only bought once a day, and it's after the market closes. So they calculate the value of their entire fund, and if you have asked during the day to buy a mutual fund, you actually buy it after the market closes when they calculate. Now, since I assume most of us are doing this for investment purposes, for long-term retirement purposes, this is not a big thing, because you're not buying and selling, 4 or 5 times a day, different things. So, but I just want you to understand, and this is another difference between how you purchase, or the same when you sell it. If you say, I want to sell my electronically traded fund, it sells right away unless you ask for something different. If you want to sell your mutual fund, it sells at the end of the day after the market has closed. And then the big thing, tax efficiency. And again, I'm not a tax expert, and I want you to consult your tax advisor. But generally, the way that EFTs are structured, they're more likely to avoid capital gains distribution to mutual funds. There was a question earlier about capital gains. So mutual fund, basically capital gains means when stocks are bought and sold. So a mutual fund, even though you are holding that mutual fund, say all of this year, they are buying and selling stock throughout the year. And you have to pay taxes on any profits that were made. The way that EFTs are structured, they are more likely to avoid the capital gains, which means you have no taxes until you actually sell the overall investment, as opposed to mutual funds where you may get more taxes even if you don't sell any of it at the end of the year. So that was that question earlier about capital gains. Something to consider. Definitely talk with your investment advisor and your tax advisor on these, but typically EFTs are more efficient. So what's happening, like I said, EFTs are 25, 30 years old. They were a very small portion of the market. They have gotten bigger and bigger. Mutual funds have been around for a lot longer, so there's more money in mutual funds. But within the last year and a half, now for new money invested, more money is going into electronically traded funds, EFTs, than is going into mutual funds. So talk about gifts to children, please. That's really a tax question. And I had this class last week. Somebody was a tax specialist, and they talked about it's $15,000 per person that can be given to a child. But I think you would need to confirm that with your tax advisor. That number was a little bit lower in prior years. I think it has gone up to that 15 before. So basically, whatever the dollar amount is, you can give that to anyone. It doesn't have to be a child, doesn't have to be a relative, from my understanding. You can give it to anyone. But if you give more than that amount, which I believe is $15,000, then there are tax consequences. The other thing is, if you are married, both you and your spouse can each give that $15,000, if that's still the limit, to one particular person. You could each do it. But other than that, it gets very complex. And you might want to, or I suggest you talk to your tax advisor. There's also other ways probably to funnel money. You can, pay for a college fund and some other options that you might be able to do if indeed you, feel comfortable with how much money you have and you want to give some based on your generosity to children and grandchildren. There will be some other options to consider.
I have a question.
Yes.
Yes, is that per year, the 15,000, or is it?
Yeah.
Period.
Yeah.
A one time.
Yeah, I believe the number is 15,000. That's, like I said, that changes regularly, so don't quote me on that. But it is per year.
Per year. Okay, thank you.
That much I can feel comfortable with. Yes. All right, some closing thoughts. Just sort of summarizing some of the things we've talked about. So we'll answer some more questions as we go through here. But what we've talked about today is understanding the basics, even with an investment advisor. Right at the end of the day, it is your money. You need to understand what's going on. You need to understand the basics, and that's what we've tried to do today. In regards to talking about it. If your investment advisor starts talking and your eyes start glazing over, like probably some of you are now with me, but hopefully not too many. You need to have them stop, slow down, and they need to explain it. As my wife calls it, you need to go to baby talk to me, is what she sometimes tells her investment advisor. You got to slow it down, give it in baby steps, make sure they understand. This is something they do every day, and they know what all these things mean. And sometimes it's more difficult to explain it than others. So that's what we're trying to make sure that you have the basics so you can understand what they're suggesting and ask some intelligent questions is really our goal here. Again, cost and fees are very important. We just talked about a few minutes ago. So again, the lower the costs, the more money in your pocket. But having said that, good investment advice is worth paying for if you don't feel comfortable investing on your own. And a true good investment advisor is worth their proverbial weight in gold, so to speak, in helping you. And it's not just helping you physically invest for that particular time. It's helping you when the stock market is going down and you feel like panicking and you've just lost 20% of your portfolio and you want to sell. Your investment advisor is there to hopefully talk you off the ledge, because the worst time to sell is while the stocks are going down, because at some point they're going to stop and they're going to start going back up again. If you sell as they're going down, you probably are not going to want to buy again. And more than likely the stocks are going to go up within the next year or two. At some point they will return and go up. I can't promise you when. Nobody can promise you when. But that's one of the things an investment advisor can do. And they can help you like other things with the questions we're being asked, how much, how can I get it so I can give more money to my grandchildren if that's what you want to do? Or how can I make it so can I go on a big trip? And once we get out of the pandemic, can I go on a big trip, take the entire family? It may cost $25,000. We're going to do something really big because we haven't seen each other for a year and a half. They can help you figure out if you can do that, how to do it, how not to get taxed too much, and help you with all those things. So there's lots of good points that investment advisors can help you with. So I just want to make sure we understand that standpoint. If you're not super comfortable investing on your own, it really does make sense to use an advisor. And then, like I said, the key is to understand your level of risk you can tolerate. If you are going to sell, if stock market goes down heavily, and it has before, it will again, just like it'll go up fast at some point in the future too, more than likely, but it will go down again, more likely. If you don't have that tolerance going all the way back to what percent you have in stock and bonds, that is probably the biggest key, because you want to be able to not panic and not sell because the stock market is going down heavily. Yes, Joanne, I see you have your hands up.
Yes, another question regarding the $15,000 gift. How does that tax-wise, how does that impact the giftor, the giftee?
Well, again,
The receiver.
I'm not a tax accountant, but my understanding, which you'd want to check, is that as long as you don't go over that 15,000, there's no tax implications for either the giver or the receiver. That's
okay, thank you.
You might want to confirm that. That's the problem, is if you do go over that amount, if you go over the 15,000, whatever that amount is now, that's when tax considerations come into play. Does that help you?
Yes, that answered it. Thank you so much.
All right. All right. What other questions out there do we have?
What about the saving? I don't know. My mom got a life insurance policy, and then when she died, we shared it up. We don't have to claim that, is what she said. And I'm worried about it. It's not 11,500 is what we get a piece.
Right. You really need to talk with that's outside of this class, and really, I hate to say it, but you need to talk with the tax advisor. It depends on how it was invested, what kind of, life insurance. There's various kinds of life insurance. So it would depend. It could be possible you don't have taxes, but it could be possible that you do.
Okay. Thank you.
I hate to be evasive, but.
Well, she was evasive. I wish she'd have told me that stuff.
Right. All right, so let me just go through a quick couple closing screens. So I give some other financial classes. I also do a little bit in architecture. In fact, another half hour or so, I'm going to have a class on Frank Lloyd Wright and his architecture. And I have a brand new architectural class starting next week. So you might want to look at some of those for something a little lighter, so to speak. You will get a email, as you know, from Get Set Up. It's labeled from Get Set Up. I will basically put it together, giving a little summary of the notes from this class, just to have you something you can remember. And also you'll get a survey. So if you have a few minutes to fill out the survey, that would be great. If you think I did a good job and you want to give me lots of stars, that's fine. If didn't meet your expectations, move the stars down, that's fine. But what I really want, if you have the time to do it, is reading your notes, even if they're not very long, just comments, because I try to constantly adapt classes based on feedback that I'm receiving from everyone. So if you have a few minutes to do that, great. Totally understand if you don't. And then please spread the word about learning with Get Set Up. You have friends, family, neighbors, anyone you think can benefit, would enjoy Get Set Up. Please try to communicate with them, and you can link into them or whatever to have them Get Set Up. And if you have a particular interest that you would maybe like to share, you don't want to be a guide and have to worry about all the technical things behind the scenes and do this regularly. But if you have some kind of interest that you might want to share, once or twice with somebody like myself or Phil or Victor helping you with doing the technical stuff, please get a hold of us because we're always interested in having somebody with the expertise and willing to share it to get with us to Get Set Up. So please keep that in mind. And with that, we're getting close to the hour, but if anybody has any other questions, we'll try to get to them now. So you guys have done a nice job asking a lot of questions as we go. I appreciate that. And like I said, we'll try to answer any one or two more closing questions here at the end. And if not, thank you very much for attending. Hope to see you in another class. I take some of these classes as well as give some, so I might see you on either end of the spectrum. And thanks so much for being so attentive.
Thank you.
All right, thank you, Renee.
Thank you, Philip.
Thanks, Victor. All right. So I'll just hang on for another second if any other closing questions here. I'm going to stop sharing my screen, but I'll stay on for a second. All right. Well, thanks. And I'm going to go ahead and end the class now. I appreciate your time and your patience. Take care. Bye.